Kobe, while people are filing in, you've got this interesting picture behind you. What do you have there?
Oh, yeah, it's just a piece of art by a local LA artist named Retina. So I've gotten into art during COVID because I got bored. So yeah.
Hello.
Cool.
Hi, everyone.
Morning, morning, everyone.
You must have been really bored, like
Yeah.
getting into art.
I think some people might take umbrage at that, but we'll come back to that, and we'll give Mr. Boyce a little rebuttal time.
I'm on the same page as you. I can't understand it really. So Art Basel here was like, what?
All right. Well, so welcome everyone to Venture Crush. Thank you for coming. I've got a couple of announcements to clear through. We are using closed caption as we always do, and you should also feel, and I'll say this a little later as well, you should feel free to drop a little info about yourselves and a LinkedIn link into the chat, and hopefully folks can actually connect a little bit that way during. There are panelist bios in an Airtable, and we'll drop a link. Maybe we already have dropped a link to that. And in addition to the panelist bios, several of my colleagues have been kind enough to do some research on our panelists today, which will make me sound smarter than I am about them. Claire Dronzik, Ike Omaruna, Kay Komuro, Kelsey Repka, and Kotran. And so I just wanted to call them out and thank them for doing it. I know they enjoyed reading about our panelists. Today, we're also kicking off our VentureCrushFG pod program. So we virtualized this program that we started in New York in 2008, because yes, there was a venture market in New York in 2008. It was really tiny. And you could actually fit everyone, in a room, well, depending on the room. It wasn't that small a room, but you could not have been COVID compliant in the room, but there was a room. And so we have about 90 companies going through that program with pods. This year, we decided to do something that we have not done before, and we're actually going to have one more pod that is sort of a late entry pod, and that is going to be led and anchored by our Lowenstein partner, Anthony Raimundo, who is out in our Palo Alto office, where it's a little warmer than it is in New York today. We have a couple of save the dates. So the next Venture Crush the next set of Venture Crushes, there's one on January 24th, which I'm also really excited about. And that one has Mac Conwell from Rare Breed. And it also has Wes Moore, who was the CEO of the other Robin Hood, I guess we're calling it, right? In this crowd, and is also a combat veteran and a best-selling author and a co-founder, a board member of the Black Economic Alliance, and many, many other things. And we also have a co-founder for that one of Code 2040, who is now a VC at Base 10. And I've been really impressed and moved, in fact, by how many people seem to have been positively impacted by Code 2040. So I think that's a super cool thing. And that is Laura Weidman Powers, who also worked in the Obama administration. So hopefully you'll join us on January 24th. We'll drop a link for folks to register for that. And so that's it for announcements. So we're going to spend a bunch of time hopefully getting to know our panelists a bit. For those of you who completed our survey, really appreciate and value that, and we will prioritize a bunch of the topics that were of interest to you. And we also appreciate the feedback that you've provided and some of the questions that you that you dropped in. So I'd love to start by getting to know our panelists a little bit personally, and then we'll have a discussion and hopefully some disagreements. And since we started with, I won't point any fingers, mention any names, but there was a little bit of, dismissive attitude toward the art world. Let's hear from an art advocate. Peter, do you want to talk a little bit about, first and foremost, your enthusiasm for the visual arts, because you also have an extraordinary history that connects to performing arts, but defend.
Oh, I appreciate that, and only in this environment, can I be so lucky to speak about this topic. So, first off, it's great to see everyone, and I know we're spanning a lot of different time zones, so this is really exciting, and this is a great way to start the year. So, as Ed is alluding to, I feel really grateful to be involved in incredible arts institutions here in New York, and so I'm someone that started out obsessed with sneakers, and then had that kind of passion for design and collecting and sense of kind of community naturally kind of scaffolded to finding myself in galleries and museums and wanting to ensure that I could be a part of like the creative energy that I think, naturally is associated with visual art. And so, despite not having studied a tremendous amount of art in my time in university, I just surrounded myself with friends who were, artists and creatives. And so I feel very, very lucky, very fortunate to kind of support in service of nonprofit arts and culture institutions in New York. I'm really inspired by. So I serve on the board of the Studio Museum in Harlem. I grew up in Washington Heights, and so that's always had a kind of a very important place in my heart. And Thelma Golden, the director there, is incredible. I'm also very lucky to serve on the board of the New Museum, which is doing very incredible frontier work as it pertains to digital art and NFTs, not just in this current moment, but really, since the very, very onset. And they launched the careers of incredible artists with their work, with shows like the Triennial, where they scour the world for incredible young artists that have never had museum shows before. And I also serve on the board of this shed. So suffice it to say, when I'm not supporting incredible entrepreneurs, I'm bringing them, for walking meetings at any of these institutions in New York. And I just find it to be such a great source of energy. And really, for me, just a great source of inspiration. I feel really grateful to learn from them.
So the Twitter take on that is going to be New York-based VC Peter Boyce admits to taking founders to the shed repeatedly. Right? Is that what I heard?
That's like, if I look at my calendar from last year, that's my happy place, and I'm sure some of the folks in the chat, some of the founders that I'm lucky to see chiming in, I think some of them have been on some of those visits with me. So we can confirm that, Ed.
Okay, so, and I'm gonna read your bio as it was sent to me. Just a short intro of you as it was sent to me.
Oh no! Oh
no,
please,
it's good.
Please,
it's good.
Please, editorial. Please take your editor's lens.
It was
that bio.
No, because it wasn't the bio you sent me. It was the bio Stephanie Botello sent me. Ed, please meet Peter. He is an all-star senior at Harvard, a founding partner of Rough Draft VC, and has been a great sounding board as I pursue my startup. I'll leave it to the two of you to connect. And that was an intro, March 28th, 2013. And we met for breakfast soon after that, when I was up speaking at our friend Jeff Puskang's class. And you knew everybody in the restaurant. So how do you become a founding partner of a venture fund when you're a college senior?
Yeah, I'm blushing, and I'm actually, I'm kind of moved to have heard the date, on that email. It's a good reminder of how lucky I feel like to have been doing this for so long. In my insanely humble origins, and even to this day, I have so much to learn. So thanks for bringing that up to me. I spent all my time in college helping friends find co-founders, find angel checks, find space to take over to host events, mentors to help them with their YC applications. And so I guess the short of it is, I spent all my time in college trying to, just enable folks to pursue their dreams and, as it pertained to kind of building technology companies. And I feel I was lucky to discover that in college. I feel like I was, I found the role that I was supposed to play, which is the source of capital, the connector, the early champion. And so I like connecting the dots. And, it was clear to me that I wasn't going to be the greatest engineer by any means. And it was also clear that the world didn't need me to found a software company. And so I feel very lucky to have found, hackathons, venture capital, starting Rough Draft Ventures to solve the funding needs of my friends to get them their first check. And so that's how this all began, and how I was lucky to get connected to incredible friends and mentors like you.
And overly kind of you there. Tell us about Stellation, and are you still just investing in friends?
Yeah, that's a good question. So really quick. So I spun out of General Catalyst last year. So this is the firm where I worked for, 9 years. I grew up there. I learned so much from David and Joel and the rest of the team. And I wanted to take everything that I learned from that experience with General Catalyst, opening the office in New York, co-leading our seed practice, expanding Rough Draft to support students. I wanted to take all of that and kind of, really kind of share another kind of unique contribution to our industry. So I'm a firm believer in being a student, of one's industry, and to learn from the folks that came before you, and kind of standing on the shoulders of giants in a way, try to find a way to make a new contribution. So Stellation is, kind of my current iteration of that. So Stellation is me as a solo GP investing in the earliest rounds of financings to support entrepreneurs, really at the, as early as possible. So, I've been enamored, by backing entrepreneurs, pre-launch, pre-product, pre-incorporation. They still have jobs other places. And being the first person to just take a chance and say, you know what, I know 3 great lawyers that can get you incorporated. I know 2 great angel investors, you know what I mean, who are going to have operational expertise for you in these areas. And look, your business is your identity, and I want to support you, and to see this through, whether it works out or not. So that's the work with Stellation. So I feel really thrilled to be championing great entrepreneurs. I see some of them in the chat. I'm so lucky to be in business with them. And also just championing the ecosystem here in New York, which you kind of alluded to. I remember those rooms, in 2008, in 2012, and so. I feel lucky to play a small part in creating more opportunity for folks to build software companies in New York.
Terrific. So we're going to go in sort of chronological order, and I didn't actually plan this, but I just, knowing that I had that email, I just looked for one other. So Reshma, I want to talk about 2 checks, and I don't mean investing checks. I actually mean Jan and Andre. So
look at all this homework. Oh God.
So, well, you and I met because for the last, I guess since 2009, I think I've been co-hosting a dinner in London with Jan Hammer at Index Ventures. And he invited you to dinner in April of 2013, a couple of weeks after I met Peter. And I have, I have that email, but it's Jan's email, and I'm not going to read it out loud. But Jan clearly, is so Jan is an advisor to a fund in Prague. You are involved in a fund in Prague. Andre Bartos may even actually be on this Venture Crush because he is co-leading a pod in our VentureCrushFG program, and I appreciate him for it. And why do you have this check component to your world?
Yeah, wow, I didn't know that's where you would start. But no, look, I think so back in 2007, when I was fortunate enough to, I think Peter's story aligns with mine too, is like fortunate enough to kind of be able to triple down on my strength in helping start Seed Camp up. I know what it's like to, everybody says, what the hell are you doing? An American in Europe, why bother? Like, this is Western Europe, right? London, starting up Seed Camp, why bother? Europeans are lazy, they like 2-hour naps, and nothing's gonna come out of there. And when then I met, I think it was maybe 2010, there's a long story with that, but when I met Andre, and I saw a lot of that, is like people just underestimating kind of what Central Eastern Europe was. And there's this new fund, Credo Ventures, that wants to look to set up there. And kind of why bother, right? Why bother helping a Prague fund? Like, your Seed Camp's already in its young days. And so I think that really, so one thing was the underdog, right? I'm an underdog, and solo GP back in 2007 when I started it. And like, I think it's like the first or second female VC setup in Europe ever, right? So all of that, when I met Andre, that attracted me to them to say, hey, there is incredible talent in Central Eastern Europe, and you need a American style VC to set up there. The ecosystem needs that, because it was so predatory over there, kind of the terms and valuations and so forth. And then the second is, who do you choose to work with, even when you mentor? And maybe that's useful for the audience, is because I think you get a lot of sort of folks pinging you about wanting your help. And so who do you choose to work with? And that was important too, is like with Andre, I really recognized this fire and this joy of working with young as in new entrepreneurs out of Central Eastern Europe, and kind of this ambition to build a better VC in CE region. So those were the two things. Like, I think not only the region deserves it, but you guys, I see the DNA to want to help further this vision.
And so I love the fact that you're non-consensus, and something we were talking about before, but you're non-consensus enough to not only decide, hey, I'm going to be an American setting up a seed stage venture fund in Europe. And then, because that's not bizarre enough, I'm going to actually also look at Central Eastern Europe and get involved in a fund in Prague. There was some ROI on that for you, no?
Yeah, just about. No, I think
a little bit, right?
Just a little bit. Without Credo, we would never have met UiPath. So just for sure, So there you go. That kind of early bird Credo and us came into that first round, and last year went public at somewhere between 20 and 40 billion. It seems to go up and down as the market is. So, but yeah, from I think it was 8 million entry valuation to a 30 billion story, right? So without that risk, or not risk, but without coming on board, yeah, that wouldn't have happened.
Right, because when you widen the aperture and get insights from people who are sitting in different places and have different backgrounds and perspectives and a different lens on the market, you maybe get a little further outside of the area where there is this incredible aggregation and narrowing of the insights in venture. I'm sorry to start with Prague, but I think it's an interesting insight into you and into how deals are sourced, since there's never been a VC pitch deck that excludes proprietary sourcing. And I don't know how many other VCs in 2009 were like, sign me up to advise a fund in Central Eastern Europe that's focused on that geography. Other than you and Jan. So kudos.
He came later, to be fair. Even though he's Czech, he came after me. So
well, but I mean, that's isn't that the index story, right?
There you go.
taking other people's great ideas and great investments and making more money on them? No?
No, you said it well. You say it well.
Okay. All right. And in fairness, Jan is a friend. I'm an LP in Index.
Yes.
And I hope that they don't cut my allocation because of that. So it's all good. All right.
I mean, I
we'll
think
come.
just to say, like, I think, we talked about pre-prep for this is like, what do you chase in life? Like, I mean, with Peter, similarly is like, love the connectivity, relationships, all of that. But I mean, are you chasing beta or are you chasing alpha? I mean, if you're chasing alpha, then you are, out there looking at things. Everyone's not, basically, because that's where the alpha is.
And looking at things everyone's not is a great segue to actually all three of our other panelists, but I'm going to use it to segue into talking to Ho. While Reshma has a number of multi, I guess, decacorns in her portfolio at Seed Camp, you also have been a non-consensus investor. You entered venture in 1990. So you've been doing it through a whole bunch of ups and downs. And you had a particularly good week in March of last year. So you want to tell us a little bit about what happened in March of last year, if you remember, if it registered. And I use the word registered intentionally there. And a little bit about the Alto story. It'll go so much better if you unmute. I'm sorry.
There you go. All right. So yeah, well, March was just a fluke. We had a couple of companies that we've been involved for a long time. Coupang since 2011, Roblox since 2008. And they both, by pure coincidence, went public back to back. I think it was a Wednesday and a Thursday. So Coupang, the first day, actually Roblox was the first one. It was a direct listing. First day market cap, I don't know, probably 30, 40 billion. It's about 50 to 60 billion now. And Coupang went the other way. The next day went, I think, peaked at over 100 billion on the first day, and then has done nothing but go down since then. But I think it's still around 50 billion. So, it's 50 billion. I'll take all day long. So that was, yeah. And it's interesting because one is from Korea and one's from US, and talking about alpha and going, where other people are not hunting. We started to invest in Korea in around 2005. Yeah, 2005, because we got started in 96. So you mentioned I got started in venture in 1990. It was my first job before business school. I was at Trinity Ventures. And 1991, a couple of interesting things happened. That was kind of recession year, only $1 billion raised in the entire industry, which is kind of crazy to think about it, right? Because we have portfolio companies that raise more than $1 billion in a single round these days. And Starbucks went public in 91. So not a tech company, not the most sexy company, but fairly well-known brand even back then, 146 stores. And then seeing what that company has done over the subsequent 3 decades informs kind of what we do in our investing. But now there's 30,000 stores and stock's gone up 330x. And it's not the 330x since IPO that we left on the table, but it's really the relationships, the networks, the knowledge that you gain building a major global company that you could apply to help the next generation. That was all lost by getting out too soon. So we try to not to do that. Now in 96, we got started in Alto's focus on Silicon Valley. We had a Korean investor. In 2005, we raised our first institutional fund from US investors. So since then, it's been primarily traditional US institutions like foundations, endowments, and family offices. And in 2005, we actually got the mandate to invest anywhere in the world up to 10% of the fund. And the reason the LPs gave us that mandate was that we wanted to spend more time in Korea, but it was structured in our LP agreements as anywhere in the world. We could just do anything outside the US. Well, we focused only in Korea. We did not want to go to China. We did not want to go to India, Israel, anywhere where other VCs were going. We had nothing to add. I'm Korean. My partner Han was Korean. He wanted to spend more time there. We also wanted to try to help the country get out from underneath this, crushing chaebol dominance. Basically, Samsung is over 20% of the entire GDP of the country, and it's a very successful country, right? But way too concentrated. And so that's kind of been our journey, and we focused only on Korea. Since then, we've kind of ventured off into other underserved areas of Asia, like Japan, Vietnam, Indonesia. We just got our first exit in Indonesia. So it's quite interesting. And so we will just kind of go where our relationships take us. And so the recent Vietnamese deal is a good example. It's a former Coupang executive, right? From Silicon Valley, went to Coupang and now is in Vietnam. So we will kind of go other places as our relationships take us, but we will specifically avoid the places that are overhunted. You know, who knew that Korea would be big enough to create multiple decacorns? We've had 5 billionaires or multi-billionaires come out of Korea from our founder base. And so that's something nobody would have expected. People did not expect the entire company to be worth $1 billion, let alone the founders become worth billions. And so that's been a very gratifying thing for us. We continue to do our investing in the US, but Korea has become a very big part of our practice. But even within the US, we hunt where other people are not hunting. Like our most recent deals in the US, I think are Detroit, Kansas City, Phoenix, LA, Mexico City. And we just signed a term sheet in Brazil. So that's coming out of our US funds. So we will go where other people are not going. So I'll pause there. Yeah.
That's awesome. And you talked about billion-dollar and multi-billion-dollar mistakes that you've made. And some of those mistakes involved a couple of the companies that you've just mentioned. And because that has led you to a style that is also pretty unique, can you talk a little bit about those mistakes and how you've corrected for making billion-dollar mistakes?
Sure. So Roblox was the specific. Roblox and Coupang actually, we both made billion-dollar mistakes multiple times with both companies. But in the case of Roblox, we sold some of our position when Index came in. Index and Meritech both came in, and we sold 15% of our shares. And that's because you have all this as a fund manager. You have all this institutional pressures to return capital. And especially in crazy bubble markets like this, and we had in the dot-com era, these paper values can be mirages, and LPs have seen these values just collapse, right? So until the money is in the bank, right, you don't know if it's a fraud or if it's for real. And some of these gains are so massive, they really want some of the cash back. So I think we're up maybe 40x on Roblox. It's like, hey, why don't you sell a little bit? So we sold a little bit, right? Unfortunately, since then, the stock has gone up another, I don't know, many multiples, enough so that that little piece that we sold was $1 billion mistake, more than $1 billion mistake. And Coupang, we had a couple of other mistakes where that probably adds up to more than $1 billion as well. And now, tying back our own personal mistakes, your personal mistakes kind of sink in very deeply, of course. But I look back to, I think there was some Twitter chatter yesterday about Sequoia having, accounted for 25% of the entire value of NASDAQ, which is about $20 trillion. Well, 25% of that value, if you break that down, it's Apple and Google. Right, those are two of their companies. That's about 23 or 24% of that 25% of the entire value of NASDAQ that Sequoia is responsible for. And so 3 trillion of it is Google. So the vast majority, not Google, Apple, vast majority. Well, Sequoia sold out the entire position before IPO, right? That's the old days of venture. You want to take some money off the table. So that goes back to Starbucks. We made $25 million on a $1.7 million investment, right? But multiply that $25 million times 330x, and that's multiple billions of dollars left on the table. But again, I say the biggest mistake is not the multiple billions of dollars left on the table, but the relationships and the knowledge and the networks you gain from a company like that, being involved with a company like that over decades, that is so incredibly powerful. And somebody like a Howard Schultz that starts his own venture fund, is on the board of eBay, is on the board of Square, does many interesting things. That best friend that you could have had as an early stage investor, it's like you said, you parted ways. It's like, hey, it's been nice knowing you, good luck, and you're gone and you're back to your little early stage companies. And so what we do at Altos is, we like to say we continue to be an early stage investor, but we're unlike any early stage investor in that we like to think of ourselves as never running out of time and never running out of money. And the way we do that is every fund that we raise, we don't raise opportunity funds or growth funds. Every fund we raise could invest in our best early companies from prior funds. And we continue to explore new opportunities. So that's how we structure it. So in our best companies, we've invested out of 3, 4, 5, 6, 7 different funds, basically. So that's how we could get multiple hundreds of millions of dollars into some of our companies. If the deals get very big, we've now done multiple SPVs that are above $100 million. So we could write $100, $200 million kind of a check into a company. And by the time we get above 50 million, we go to SPVs. Anything below 50 million, we could kind of handle through the series of funds that we have. So that's where we're a little bit different than the typical early stage. And we're also different from later stage investors that are chasing all these unicorns all over the world, because we don't invest in somebody else's unicorn. We just develop our own companies. And when we invest at the unicorn stage, it's in our own companies, not somebody else's company. Yeah.
You're very possessive with these unicorns. So and
after a few billion-dollar mistakes, I tend to get a little more. Yeah.
Right. And a sign of that is that at the time of listing, you owned 23.6% of Roblox Class A shares, which the press reported, I'm not asking you to confirm or deny, was worth about $7.5 billion. And I want to actually, it's not that I forget that I'm also a lawyer, but for the past 30 years, I have been a lawyer, mostly to startups, growth companies, and venture funds. And what you described that you do is something that lawyers are supposed to tell venture funds not to ever do. So cross-fund investing, don't try this at home, you could lose an eye. It is something that is known to be problematic because your investor base in fund 1 or 2 is going to get angry that you've cut fund 3 in on a sweetheart deal on an early company. And similarly, fund 3 investors are going to get angry, and a synonym for get angry would be sue you, if they feel that you have fooled them into propping up with an ill-advised up round your prior companies. Now, the antidote to that is making everyone a shit ton of money. So as long as you're confident that you're going to make everyone an extraordinary amount of money, it becomes less of a problem. Just throwing that out there as like your legal point.
Well, you were a very good lawyer and you were giving good advice, and we got the same advice. And so, and our LPs put us on a very short leash. They didn't like it when we proposed.
So, sorry, your definition of a short leash is 23.6% of the entire outstanding shares in a company where the fund out of which you invested was like a $50 million fund, right? Out of which you wrote your first check.
Yeah, it was an $86 million fund.
Okay.
$86 million fund. But we invested out of multiple funds and then a couple of SPVs at the end as well. So that's how we increased our ownership over time. Yeah.
Amazing. Okay.
Our original investment was, believe it or not, it was a $6 million pre. We offered a $2 million Series C term sheet. So not A, B, C, because A and B were friends and family, and $2 million offer. And the family, we had to be interviewed by the father and the brother who were on the board. The brother's still on the board, a good friend of ours. And he said, well, $2 million, that's just a lot of money. Like we won't let you have 2, like we'll take 1.5 from you. And then $500,000 came from, again, the friends and family. And so that $500,000, I think that they cut us out of on that deal is Yeah, it's a couple of $1 billion now. So but we're still friends now. What ended up happening was we said, it's like, okay, well, we could only have 1.5. It's like, well, we'll take whatever we can get. And then since then, like basically we've been investing more and more. So on 5 separate occasions, we actually bought secondaries because the company was cash flow positive fairly early on, didn't need that much money. So we just kept buying more secondaries. And then the SPVs were also mostly secondaries all along the way. So that's how we increase our ownership over time. Yeah.
I mean, he's playing a very different game, right? Like I do think contextually, he knows what game he's playing, and you got to know what game you're playing.
Yeah.
I mean, so I think you mentioned 2 stocks, one is up, one is down, and take a UiPath. We still hold shares in the public market, but the price is 2/3 of what it was in the last private round that was done over 12 months or close to 12 months ago. That's sitting there, right, with a year of negative return, right? And so you got to know the game you're playing, and the alignment with sort of your team, founders, and LPs, because I think all of us can count the money we left on the table as such, but then there's definitely, and you can't predict cycles, or I can't. And so
there is something to longevity, and I want to use that to move to Wendy, and then we'll come back to Kobe, and then everyone hopefully will jump in. And I appreciate you jumping in there, because it gets a great point. What Ho is doing is completely different, and there's also an extent to which what Wendy and North Zone do is very different. And there's backdrop, because North Zone was founded, I believe, the same year as Altos, 1996. And North Zone is an incredible fund complex, originally headquartered in Europe. Wendy's, you're the first New York hire for North Zone, which was I believe you started there in 2015.
Yeah.
And you also have your multi-billion-dollar portfolio company that you came in early on and are a strong believer and supporter for that company. And love to hear a little bit about your background, which I have had the pleasure to know. But talk a little bit about your background.
Well, I would like to maybe start a little bit with North Zone's heritage, and then maybe lace in my background, because I think it fits really well with the story that North Zone tells about our global expansion, and perhaps we'll frame it a little bit more for the audience as well. And by the way, I've just been having the greatest time scrolling through the boxes on Zoom, looking at your faces. This is like sort of, I guess, the new age equivalent of looking out into the audience and seeing if you're boring everyone. So I have been, trying to see everyone. So North Zone started in 1996, as you mentioned, and it's historically been one of the first kind of venture fund that really looked to emulate the Silicon Valley style of venture investing in Europe. And at the time, we started with 4 equal partners. And since then, 25 years later, we've become one of the only funds to fully replenish the partnership with true generational shift. And given the context of Europe kind of exploding in the venture arena in the past 5 years, I'm sure this is something we've talked about in past Venture Crush formats. But to put some dollar terms to it, European valued unicorns grew to $500 billion, which is 5 times what it was 4 years ago. And being also one of the first.
Wendy, I think you're in a Nordic freeze right now.
Oh. Can you guys still hear me?
Yeah, now we do.
Okay. Hopefully that doesn't give out. I'm at a WeWork right now, so the internet might be a bit funky. So I was talking about European venture numbers in the context of the last 4 years, which, Ed, I feel like you must be very familiar with as one of the first LPs to take an active interest in that geography, investing personally. But in the past 5 years, it's grown up to $500 billion with over 120 unicorns. And so kind of starting my career in venture right at the beginning of that, joining a European fund that then at the time had saw the opportunity, and I'll talk more about that later, of launching internationally, was a really exciting time. And of the 120 unicorns in Europe, many of them are ours, and 13 in the past year alone, which is mind-blowing, including one of the fastest growing, Hopin, one of the most, I think, highly valued private company in Europe, Klarna, and then the second highest valued publicly, Spotify. So with that context, joining, I had my start in venture actually in Ed, your class at Columbia. I was starting a company similar to your story, Peter. I realized, there was a lot of fulfillment from building my own purpose and kind of, seeing that realized, but also really enjoyed kind of working with founders and helping them see their purpose fulfilled. And that was actually more interesting to me as I started to have more conversations with PJ, the partner that recruited me here in the US. And I think the reason we came here, which is very sort of coincidental to when I first met North Zone, is that we have this, what we like to call a global model. So it's a global coverage model where we also try to see kind of these, high level sector trends arising from consumers and business buyers quite globally in terms of, tech adoption in general. But locally in these kind of underlooked hubs, we started out, as you mentioned originally, in Scandinavia, which is a really underlooked hub. We have these local relationship teams that kind of overlay that sector experience with actual, human relationships that we really love and enjoy and, have spent a lot of time cultivating. And so in New York, we were looking to replicate that model that we already had in London, in Stockholm, in the DACH region, and some of the other key hubs in Europe that were producing kind of these great companies. And what we were noticing were sector-driven trends, such as consumers were really starting to destigmatize mental health care, for example. Yet the go-to-market for that model in Europe is much more complicated because of the various pockets of money sitting with various governments and public healthcare and so on. And so we brought, that's one of the examples of the sector opportunities we identified. And we brought that thinking into the US market and was able to find a really amazing company built by an amazing team that was going after a much more lucrative market in terms of, straightforward go-to-market motion and sort of budget. And then we've also done similarly with, for example, our insights from media, seeing kind of how that content chain is completely, bottlenecked by sort of people that had capital and had power, and then seeing kind of a digital platform being able to aggregate some of the consumer attention and sort of disrupting it as similarly as they did in Spotify. We invested in a similar media company here in the US. So it all kind of ties together. And my personal journey here at North Zone has been taking some of those sector insights we've developed now throughout our 25 years globally and applying them to New York. And one interesting thing I'll just mention where I'm spending a lot of time is finally, for the first time, we're seeing web infrastructure development happen outside of Silicon Valley predominantly, where it was happening for a lot of time. And this is sort of the Web3, wave that many of you might have been hearing about, but I kind of entered the scene in New York at the time, totally fresh into venture, just having graduated from Columbia, and fell into kind of the crypto rabbit hole back then. I think it was the blockchain crypto rabbit hole, because I was fascinated by some of the idealist visions that were being kind of built in that community. And then tying them with theory and, seeing kind of, creatively what could become a really interesting, more idealist version of the internet now being built kind of piece by piece from the bottoms up. that's a great opportunity for any fund that has a global perspective, because that infrastructure for the first time is being able to be built in New York, in Europe, in Asia, anywhere in the world. And so that's where I'm spending a lot of my time thinking and writing, and happens to be sort of locally where my relationship hub is as well.
One of the conversations that that you and I have had multiple times over the years, and that we recently had with Kobe, is investing in a way that aligns with your values, not your financial values, but your values, your principles. You mentioned that discussion of mental health, consideration of mental health, for instance, has been is starting to be less stigmatized. It is still, I think, pretty stigmatized. We don't necessarily think of it as polite conversation at this time. How has that been an investment thesis to you, and the fact that that's important to you? How does that harmonize with values alignment in the way you invest?
Well, I think there's like two ways to look at it. There's the right brain way of looking at it, which is like, are these your personal values, and the personal values of your partnership, are they aligned, and your LP, and do you kind of, push those forward in your conversations regardless? And then there's sort of the economic, more left brain way of looking at it, which are these underinvested areas with a lot of human impact, and bringing in kind of, the monetary impact to human impact is actually, a little bit more straightforward than you might think, especially now with newer technologies that allow incentives to be better aligned. And so, I'll spend a few minutes on the kind of first part, which is, my personal values. I think it gives me purpose to do, what I do and help founders realize their vision. And I think having, I think it was important for me to be in a partnership, and I think for many founders to align with partners that are, doing that for the purpose of their personal values, because it makes a lot of discussions easier and things to be built on trust. It makes trust building much easier. And then on sort of the economic argument, I think mental health care being a great example of this, and I would argue in the future climate and some other wellness sort of, actually, I would break it down in this way. I think we've been looking at technology advancement for its own sake for quite some time, because it was underinvested in. And that drove significant returns for a very long time for some of the best storied venture firms in the world, and public investors at that. But now I do question whether we've just now over optimized for technology for its own sake. And nothing against ad tech, but I'd like to take this as an example because it's a little bit circular. If you think about it, it's like we're monetizing people's attention to get them to click more, and then your smartest minds are going into like over engineering this engine to get people to waste time, essentially. Lots of great ad tech companies out there, and I am totally oversimplifying for the sake of argument, but there are other things like that you can imagine. I think there are other buckets of impact, of human impact and environmental impact that could benefit from the same level of investment in addition to technology, because now we've built the basic rail. So if you look at the dollar impact of technology to healthcare adoption, it's just like tremendous compared to the dollar impact of a technology, maybe, food delivery or ad tech platform. And so those are my loose thoughts. I think to get deeper into the actual traction of where the technology wedge can enter into the behavior of these people operating in these sectors. I think technology that enables SMBs is another great example.
I think Wendy is frozen again. All right, so when Wendy, yep, there you go.
Hi.
Nope. Yeah. Sorry, you froze for like 2 seconds.
Okay, I'm back. Am I back?
Yeah.
Okay. Yeah, I think I look for kind of fun to diversify, or not diversify, but to start to emphasize more the human and the environmental impact of their investments in the coming years as a result of kind of this more economic rationale.
So when you talk about, you know, investing along those values, and Kobe, you've been remarkably patient. You all have, and I appreciate the indulgence of the long format. And actually, you know, Kobe, I'm not sure whether I've known you for 15 or 18 years, but it's sometime in that time frame dating back to when you were at Insight and then OpenView and Excel, and we worked together at those three places. And you've been a CMO twice, and you brought us in as company counsel for one of those, which was sold to a PE fund. And you had this, you know, amazing career as an athlete, also at Harvard. You're now at Upfront, where you're a general partner, but that's not necessarily the most exciting part of the story. Sure, you've been at all of these like top tier venture funds and done these amazing things. You're also not just talking publicly about your values, but you have been a founder on the side, or maybe in front, raised your own capital for that company, staffed it up. So you want to tell us a little bit about what you're doing with Valence?
Yeah, 1000%. So Valence was frankly an idea that came to me while I was sitting in my office at Upfront and reflecting on a problem that I was seeing firsthand as it relates to one venture capitalist saying that, oh, they wanted to fund Black founders, but they're like, oh, I have no idea where they are. There are no Black founders out there. And then also I was hearing companies saying, oh, I want to hire all this Black talent. Like, Kobe, you're Black. You probably know all the Black engineers, Black salespeople. I'm just like, contrary to popular belief, Black people don't know everyone. That's not the way this works. But I was realizing that if the way in which people were sourcing talent was asking their one Black friend if they had one, also heard stories that people were going on LinkedIn searching for Black sounding names as a way to actually create a pipeline of talent. And then also I was just talking to venture capitalists that said they wanted to find more Black founders, and I would rattle off names of, you know, Black investors like Peter and other folks. And I said, hey, do you know these individuals? They're like, I never even heard of those folks. And I was like, oh my God, like part of the issue is that there was just lack of transparency around the network. And I realized I could do two things. I could either just tell folks that, hey, there's no pipeline problem, work harder, or actually could figure out a way to solve it. And I realized the most productive use of my time would be not to complain, but actually try to create something to solve it. And for me, it wasn't an issue around like taking my time and actually speaking more. It was more around like, how can I think about leveraging technology to solve this problem? Because if we're not leveraging technology to solve the problem around how do we help create Black wealth and create a mechanism by which the Black community can have more of a connection with the innovation economy, then I'm under optimizing my efforts towards trying to solve this problem. So it originally really wasn't supposed to be a company. It was just a website that was supposed to be a visualized database of Black talent. And I wanted to do it in a way where it was very easy to discover and find individuals through the structured taxonomy I created around talent. But then I wanted to create a brand layer that celebrated the community through this very aspirational lens, using superheroes as that vehicle. And the superhero analogy came to life partially when I first met a founder and a good friend, Paul Judge, where he was raising capital for his Wi-Fi networking startup called Luma while I was at Excel. And we had a meeting set up at CES. I didn't research him in advance, neither did he research myself. And then we had this meeting and we kind of like walk into the room, kind of look at each other like, oh, you're Black. Because we're not used to actually having the other person on the other side of the table to be Black. And then we ultimately invested that company at Excel. But he said that it was kind of interesting where it kind of felt like almost like X-Men, where you feel like you're the only mutant and then you see other mutants out there. And then I was like, why don't I create, if anyone's sort of a superhero comic book junkie, is like, I'm gonna create Cerebro, which is that platform that allows people to actually discover mutants all around the world. So long story short, I created this website And I started getting feedback from people saying, "Oh, this should be a business." I'm like, my website should be a business. Like, I'm a VC. I'm not interested in running a business. But then more and more people kept saying it should be a business. And then I ultimately had other VC friends saying, "I want to fund this." And I was like, "Well, gosh, like with VC, I could kind of fund my own damn thing if I want to." So then I told my partners when I was kind of packing on the side because they had no idea. And then we ultimately decided, yeah, we should incubate this, and had the privileged opportunity to put $1 million of upfront capital into this endeavor. And not because it was just like the right thing to do, but we also really felt that it was a platform that could really drive also really good returns for our LPs, which is why we put our LPs dollars to work here. So for a while, I was spending my full-time job as a GP at Upfront, and I was working firsthand to build this company, which with two young kids at home, I don't recommend it to most folks to try and balance all that at once. But long story short, we launched this platform after building out a small team, having a few events out in the wild that really got validation around the concept. Had initial like 5,000 people migrate to the platform at launch. Fast forward to 6 months later, early 2020, I was able to recruit a phenomenal CEO named Guy Primus, who I've been stalking for years, to try to actually run this thing. And he came on board to be CEO. And then George Floyd it, and it was like, wow, like this became much more of an important endeavor and platform than any of us ever truly realized. The amount of attention that came onto what we're building was like magnified by probably order of magnitude. Because I'll be honest, pre-George Floyd, I'd say a lot of people frankly doubted or honestly didn't even care what we're building, which was interesting when you're going out to actually raise follow-on capital to get other investors to tell you that your baby's ugly, it doesn't really matter. I kind of felt like being on the other side, like, wow, this is how it is to be a founder raising money. Like, you kind of can't take it all personal. But fortunate enough, we were able to raise a solid Series A from GGV and Hans Tung coming on the board, really seeing the mission of what we're trying to build. And fast forward, we are right now, we have close to 20,000 professionals on the platform. We've really pivoted to be more of an experience where it's an executive development program where corporations can sponsor individuals within their companies to go through this kind of cohort-based learning platform that we've layered on professional development content as well as a peer networking component to really create a vehicle by which companies can better invest in their rising Black talent, as well as individuals can just pay their own way through. And then we have a non-paid experience where members can come on the community and be there, find one another, connect, build. And the amount of success stories and anecdotes I hear from the serendipitous encounters that happen through the platform that's changed people's lives is honestly humbling and awesome. But it's just one of those activities that now I'm spending my time, which is, it doesn't need to be mutually exclusive, how I can really focus on trying to drive Black wealth, helping my community, as well as investing and being a venture capitalist. Like, they're one and the same. I should be investing in Black founders and individuals and entities that can help drive Black wealth, because it truly is a massive opportunity with regards to economic outcomes, but also it's the right thing to do with regards to being able to take the opportunity to fund a highly talented portion of our population that's underserved and give them the runway to run hard, run fast. So a lot of my recent investments, many of them are not yet announced, unfortunately, are behind Black founders, where I've given them about $3 to $4 million, potentially with an idea on a napkin, and letting them run, skip first base, and go, because we need more of that at play here. So that's kind of where I'm spending a lot of my time, and I'm truly passionate about in terms of how I can just go through the next stage of my venture career.
So it's an amazing initiative, and I love what you and Valence and Guy and Hans are doing. I also love the fact that you're letting them skip first base. And I want to pause on this for a minute, because in this country, in America, we have an intentionally created and an intentionally perpetuated wealth gap that is based on racism and misogyny and homophobia, among other things. It is harder, and there's math on this, right? There's lots of data. It is harder for Black founders to raise friends and family. It is harder for Black founders to raise seed funding or pre-seed funding. It is harder for Black founders to get those warm intros and to be in network. And so it's almost like you're not letting them pass first base. It's that you are, so much of venture talks about investing where you have an unfair advantage. And I'm going to change the word unfair here. There is an inequitable advantage. And I'm using inequitable in multiple dimensions here, right? Because the advantage exists because of the systemic racism inherent in the way our venture industry has blossomed. And so investing where other people aren't, whether that's in Central Eastern Europe, where Reshma became an advisor to Credo, or in London, where Seed Camp was founded, or doing some of the things that Peter is doing at Stellation, that Ho was doing in South Korea, or that Wendy's doing in mental health, investing where people aren't. And there is a geography that exists because the people who live down the block from us or 5 minutes away, but who don't go to, and us, I mean people who look like me, but aren't invited to the parties, our weddings. If you look at wedding pictures, you want to understand a racial divide, look at wedding pictures, right? And see who's invited to the wedding. Investing in that geography that is overlooked, that geography that is out of the loop, those people, that's an incredible economic opportunity. And so maybe we can talk a little bit more about that and how you're seeing that opportunity.
Yeah, I think
you want to start,
Well, I'd say it's a combination, not only even just the individuals, and those individuals not being in the same rooms, having access to the same network, but even if those individuals have access to that network and those partners that are writing those checks, another issue is that some of those individuals may be working on issues or opportunities or things that may disproportionately affect their own population that aren't relatable use cases to that investor. So they see a couple of deals come across the desk, and they're like, oh, I get this random SaaS tool that was brought up during the board meeting with my other companies, and all these funds are chasing it as well. Let me spin up all the team to go and hop on a plane to get this cheap deal chased down, versus a Black founder who's going after a multi-billion-dollar opportunity that affects disproportionately their community, that has some unfair advantage. But the VC is like, I don't get that. Do really truly people care about that category? And then because there's not this dynamic of it being the hot deal and the FOMO with regards to winning the deal, that founder struggles to raise, will raise potentially at suboptimal terms, and it becomes a compounding dynamic with regards to founder not having access to the actual individuals writing checks, and two, working on use cases that aren't relatable. And I think what we need to do is be more focused on putting capital behind those founders and understanding those use cases and being open-minded with regards to problems that we may not be day-to-day thinking about. And for the time being, I'm gonna be writing those checks all day long because I see it as just an amazing opportunity to not only back up founders that deserve that capital, but two, to create top-tier returns for my investors. So that's kind of what I think about is a second part of the problem with regards to not only access, but also what are people working on.
And I think to pick up on that last point on top-tier returns, because I mean, at the end of the day, what are you also as a fund manager? And you are a steward of capital, of whether it's your own as a GP puts it in, or others who are LPs. And so I think role models and constantly actually pushing role models across all, us as a panel, a group of panel that represent that, so important, right? That there are top tier returns to be had with looking at the needs and attacking the problems with solutions across sectors that are not the latest kind of marketing, dev marketing tool that, as you said, you hear from a couple of board meetings, right? Like well beyond that, there are massive problems worth, you know, massive billions, right? And so, you know, I'm a big proponent of that. Is like more role models, more, but with that focus on top tier returns, is that does matter. You know, that does matter to produce that.
Yes.
I see Peter smiling, moving his head and reaching for the unmute.
Yeah, no, I'm just thinking, you know, I just signed off on docs, you know what I mean, backing an incredible kind of women founded business here in New York, you know, literally before I hopped on the Zoom. So I'm super excited for them. Just announcing, you know, first investment I made in Detroit. You know, which is an incredible entrepreneur of color who's looking to kind of reinvent the music industry again in Detroit. So I'm really thrilled for that. Gonna close 2 more investments, you know, next week in women-founded businesses. So I think we're all in this together. You know, at the end of the day, we all need opportunities. We all need to take a chance on each other. And I think to, you know, the points that Kobe and Reshma made, you know, I think this is an incredible business. This is, you know, we all want to use technology to change and improve the world that we're in. And we each have a part to play in this, which I just think is just so exciting when I think about the energy for 2022 and beyond. So I'm just smiling thinking about, you know, like the confluence, you know what I mean? And just the opportunity set, and also the group that's, you know, all on this Zoom together, you know what I mean? Like, and I'm just also just getting the energy, you know what I mean, for everyone kind of interact with each other. So I'm excited. I'm excited to be at forums like this.
And I think to say that we're not no-name brands and people here on this Zoom call too, like, which, I mean, I think 10 years ago was different, right? 20 years ago was, so it is just, it is inspiring. It's great. Like, it's such a positive, you know, movement in the positive direction, but we're not, you know, not nearly done yet, right? Like, so we just got to keep pushing these kinds of forums.
The sad but amazing and inspiring opportunity here is you can still get in super early. And I know that there has been a loss of momentum from the post George Floyd, Breonna Taylor, Dominique Fells, and I do think it's important to mention the women and the LGBTQ and trans community in particular in this, because you know, you have to say her name. It's not just one person, and there's been too much overlooking. There was this great momentum toward, you know, okay, let's write checks, let's do something, and that momentum has a half-life, and we have not fulfilled on that promise. So the opportunity to invest in and to say, I'm going to take money from venture investors who don't look like me, or venture investors who are underrepresented, or founders who are underrepresented, or founders who are serving an underrepresented community, or a community that has not been as served entrepreneurially or by the venture industry. That opportunity is massive. And if you want to talk about Ho and the guidance that, you know, he has used to make billions of dollars for himself and his investors, of, you know, we don't go in places that are overshopped by venture investors. This is kind of that place. So now let's maybe flip.
And I want to make just one quick comment on that point, because I think we do have to, of course, deliver, you know, good returns for our LPs, for them to continue to fund newer funds so we can continue to do the good work. But I think we all have to kind of take a leap of faith here, because I think it's not about the returns. It's about supporting these people that deserve a chance, and again, not doing what everybody else is doing, doing something different, and supporting people who are different, and solving important problems, and just take a leap of faith that if you do good work, that you will be rewarded, that the returns will be there, but don't chase the returns. And if you're doing what everybody else is doing, you might get great returns, but you're not gonna get any alpha. You're not gonna look different. You're not gonna stand out. So do something different, and don't go where everybody else is going.
So wait,
So anyway, it's not about chasing returns. I just think
no, hold on. What,
Yeah.
but why not? And so I've been LP investing in venture funds personally with my wife Betsy for over a decade. And I looked at my performance from the first 4 years that Betsy and I were deploying as LPs in venture funds, 2010 or 11 to about 14. There were 28 funds that we invested in. And they include like the biggest name brands, right? Excel, First Round, great funds. And 9 of those were 50% or more led by underrepresented managers. Our total value, including dollars back, when I take out the funds that were underrepresented led from that period, those funds return to us about 4 times our money. The aggregate group of 28 returned just under 4 times our money. And so I think it's totally fine to have your capitalist lens applied to this space and to say, there are people who are underrepresented who are going to get incredibly outsized returns, whether as founders or as investors themselves and stewards of your capital, because they're amazingly talented people. And by the way, if you look at, and sports is, and I know so little about sports, but sports is a great analogy, because if you look at, the way that Satchel Paige pitched in his 40s and what he had to have gone through to be better than everybody else on the field, there's an incredible talent pool there that is really available to us. And Reshma, I don't know that I can count how many times you've been on the Forbes Midas list of the 100 most successful, mathematically successful venture investors in the world. But I know you've been on there a number of times, and that's because you have brought home big frickin' dollars. And so I'm not saying that you shouldn't also have your values alignment hat on, but for me with First Close Partners, and I love the fact that you and Reshma and Wendy are LPs in First Close Partners. So thank you all for that. But with First Close Partners, we are capitalists. We are making money with the underrepresented managers we back, not on, but with, and that's the lens that we apply.
I mean, I think you can't divorce reality, right? There's a certain reality we live in, and so we're pushing barriers, but you're also living in it, and you operate in it. So it's kind of that it's a balance, it's a dance, and I certainly would say the 6 of us here, that's the vision of the world. I want that group to be wealthy because it's I think it's the right way to move forward, right? So I mean, again, it that matter. Like again, it has power, right?
And just to be clear, I think maybe what you're talking about is that when you invest in a first-time manager, for instance, or you invest in an entrepreneur who hasn't done it before, you might have to look for other indicators of future performance. And if, it'd be great, given how prolific an investor you have been in a values-aligned way, because I know you're also backing lots of underrepresented led funds. And you also, there's a blog post you wrote, I think 16 years ago, about hedgehogs and foxes. And you talked about a particular entrepreneur who started a furniture business in the 1930s and retired grudgingly at the age of 95. And there weren't a whole lot of VCs touting that level of depression era female entrepreneurship back in 2006. So do you want to talk about some of the things that you look for? Because there are also a lot of founders here who want to know what they need to show as proof points to incredibly successful investors.
Yeah, like the people who bet on us, our first institutional fund, the first LP was African-American LPs. and they gave us a chance, right? They're looking for something different. And we did not come out of central casting. And one of our, you mentioned the Rose Blumpkin, the furniture entrepreneur. Actually, you know, the first Korean ever to sign the Buffett Gates gifting pledge is this guy, Bong Jin, who founded a company called Woa Brothers, which we sold last year. He did not go to the top tier school. And in Korea, education is very important. If you didn't go to Seoul National, which is the equivalent of Harvard of Korea, or KAIST, which is the equivalent of MIT of Korea, good luck getting a job. Like, well, he didn't go to one of those schools. And his prior company failed. He was a designer, a furniture designer, actually. And so he had to go to work at Naver, which is like the Google of Korea, to pay off his debts and started this company. And one of the most amazing entrepreneurs we've ever backed. So you got to give those kinds of people a chance. And again, if you're chasing returns, I think, you know, we would have gone after China or something like that, India, big markets, you know, and go after somebody who, you know, comes from the top tier schools or whatever. And I just think you gotta give people a chance. You can't go where other people are going and then take a leap of faith that will lead to the top tier returns. But the conventional wisdom is that that's not going to. And I just think chasing returns is like chasing happiness. If you chase happiness, you're not going to get it. You chase something else. You chase meaning, value creation, working with great people, again, creating value, and have faith that that is going to return, lead to great returns. But you can't be chasing the returns. You got to be chasing meaning and impact and value and all of those things. Yeah.
Yeah, and to riff off that for just 10 seconds, because I've spent a fair amount of the holidays kind of just watching documentaries about the music industry and A&R and just kind of watching myself. And that, I mean, I think so much of it is about like the artistry, the craft, the relationship with the founders that we are lucky to work with. And then, you know, everything ends up being an emergent property of those relationships and the incredible work that they do. You know what I mean? Like, you know, all of the returns and the impacts on society, you know, end up being just emergent properties of the founders that we're lucky to work with. And so just thinking about, you know, and being contrarian and right, I think is another aspect of that, you know what I mean? Where it's just like, you know, signing, you know, like Nirvana or Nine Inch Nails or, you know, Dr. Dre at the time, you know what I mean, seemed, you know, totally crazy, you know what I mean? But it's like, that's what society wanted, you know what I mean, to have shown up and said, oh my gosh, after, you know, 10 minutes with Eminem, you know what I mean? You're just kind of like, holy God, we got to get a contract, you know what I mean? Like ASAP, I've never heard it sound like this, you know what I mean? Like, and just loving that, you know what I mean? And so I think especially for early stage investing, because so much of it is intuitive, it's about the relationship, it's about just enjoying what the ride can be, you know what I mean? And, you know, knocking on wood, it ends up being like some of the rides that Ho and Kobe and Wendy and everyone here has been on, you know what I mean? Which leads to, you know, IPOs and then, you know, great kind of, you know, social work that emerges from that, recycling all of the returns to create opportunities for the next generation of entrepreneurs and managers. And so, you know, I think all of that ends up being an emergent property of, you know, just being lucky enough to work with incredible founders.
Yeah.
And sorry, go ahead, Kobe.
I'd say, I mean, our job is just to take risk in the face of our fellow partners, potentially a majority of the industry, looking at a bet we're willing to take and thinking like, wow, that person is totally crazy. What the hell did they just fund? They're an absolute moron. And then you seeing something that no one else sees. Like for me, like that's where I've definitely made the most money in my career. And also, I mean, I where I've seen cases where I wish I did write that check, where it was a company that I'll remain nameless, was mentioned many times during this discussion, where I was just like, that thing was like, it was long in the tooth. No one cared about it. Everyone said like, it's not an interesting company and it gets to be worth like tens of billions of dollars. And like, our job is to be able to take those risks despite all the odds and following the herd mentality. And right now it's just, man, it's so easy, especially in the early stage, to, you know, fund that founder that comes out of central casting that has some sort of like stats on their resume that makes you like, oh, like I'm not going to get fired for writing a $3 to $4 million check to this founder who probably if they get some bit of like product market fit in their product, is going to raise their Series A or Series B despite any traction at like a greater than $100 million post money, and suddenly like I'm a hero because my on paper markup. But like that's like not where our job is. Our job is to chase after incredibly talented, passionate founders who are trying to change the world in a meaningful manner, and hopefully it results in it being a ginormous outcome for the.
I mean, it does result in a ginormous outcome because if you have a billion people using something, so I mean, you take kind of sectors like female health, which still lag dramatically, right? And mental health and others. I mean, we've backed a company called Spill, which is enabling employers to give their employees, especially through the pandemic, it's been amazing, a therapist for everyone. And I mean, I'm a huge believer. Literally 7 billion people need a therapist. So someone to talk to. Right? So I think if that's the vision, because that's better for global mental health, then I mean that's what you want to back, because that will correlate with incredible returns if there are 7 billion people with a therapist on hand, right? Or someone to chat with. So again, like I mean, it's gonna connect with that, is that you're gonna have crazy returns if you are impacting 1 million, 10 million, 100 million, 1 billion people, and negatively if you're Facebook and impacting also a couple of billion people, right? So it's just, yeah.
If you think about mental biases of investors and venture capitalists, the same as you think about geographies, it's the same as going where people haven't gone before. And when it comes to biases, more so than geographies, there's more areas to differentiate, I think. The hard part is to continue to innovate on that, because once it becomes successful, people follow, and then it becomes the norm again.
And two quick things. One, Ho, I'm so glad that you expanded on the earlier comment, because I hope that it didn't come across as saying that you were, as my saying that you were looking at these not because they were financial opportunities as well, but you were saying don't just be a calculating capitalist when you look at these. You're looking for the impact and something that can be, that can be massive. And so you said it far more insightfully and eloquently than I. Great. And on these comments, and Wendy in particular yours, you've got this interesting issue of, do you let the bias itself become reinforcing? So for instance, if we know, and I know that Chantal Raymond put in the chat, and I can't read, I haven't been able to keep up with the chat and this conversation, but my ADHD allows me to keep up with the chat a little bit. But she said, and it's even much worse for Black women, and the stats on that, and as a board member since 2019 at Black Women Talk Tech, like we have stats. The stats on Black women getting venture funding, it's a number that rounds to zero. The stats on Black women getting LP funding as VCs also rounds to zero. Add them together, it still rounds to zero. And so do you say, okay, there's less funding risk when I back this white male founder who went to one of the 10 approved universities, or in the UK, and there's research out of the UK that 20% of all VCs in the UK went to 4 schools. Crazy, right? Because funding risk is a really big deal at seed and pre-seed. So what are ways we can correct when people say, yes, this person mathematically is less probable to get next round funding? How do we get past that? I'm not suggesting that people should lean into it. I want to de-bias that.
I think microly, like on the sort of the behavioral level, it's correcting things like language that reveal thinking patterns that are biased, and having that just radiate out from how you conduct yourself daily. And hopefully by then you surround yourself with a cohort of people that can help you do that. But on sort of the macro level, if you think about how people build their mental models, it's using data, which is why, by the time that certain biases have been corrected, they tend not to become alpha drivers anymore. And so I think building more data and using kind of, that in your argument to help yourself, not even think that, like to reduce your own risk of that, because there is so much capital out there. There's so many multi-stage funds, such as North Zone out there that are, able to contribute. I don't know that lack of capital for talented founders is a conversation we would be having kind of right now as much as we had maybe 5 to 10 years ago.
I don't know.
So go ahead. Yeah.
I'll wait. I think my personal opinion on how partners at funds think about funding underrepresented founders, particularly even Black women, which are disproportionately underinvested in, it's less around funding risk, because the loss ratio on non-Black founders it's a Series A and C. It's still pretty high. I think it's more around career risk. So the career risk around like, oh, if I don't invest in this founder that my partners see is like, oh, that's like the founder that we should be chasing after. So therefore, I'm like doing my job of getting into hot deals. It's different, like, oh, am I funding like the Black female founder that is not like the normal founder that all of us are partners are chasing after? And there needs to be a shift in regards to psychology by which the venture community is just spending more time blacking underrepresented founders, period. And I think that's where we're seeing issues. People rather, unfortunately, spend their time chasing after the founders coming out of central casting versus looking at these underrepresented areas, because the loss ratios are still probably going to be somewhat equal, if not even better, back into the underrepresented founders. Anyways, that's my at least qualitative perspective.
I was going to say, we live in a very distorted world right now. It's like the dot-com bubble era, where entrepreneurs who have this amazing fundraising ability are getting rewarded, right? And entrepreneurs are optimizing more for fundraising prowess rather than building companies and building value. And so if you're playing this money-losing unicorn game of raising more and more and more and more, that's a loser's game, I think, for everybody, but especially for underrepresented founders and people not from central casting and people who don't have the networks and the friends and the rich uncles that are going to invest. That's a dangerous game. So the way we try to help these founders is just to get them to a point where they could control their own destiny, which means getting to cash flow break even somehow. And if you do that, and if you don't need money, then believe me, people are going to be knocking on your door wanting to invest in your money. And that's not a very popular thing to say. That's how we like to build all of our companies. But that is not a popular thing to say. And that's seen as a very old-fashioned, stodgy, and you don't get it. You don't get it. This is like the whole new world kind of a thing. But I've heard that before. And so I'll just tell you what we do is in order to protect the founders, we try to build companies that don't need a whole lot of money and don't keep running out of money. Because if you are not from central casting and you have a company that just keeps running out of money, and you want to then go talk to all these investors who really do not fund minorities and you want to get more money from them, good luck. That's a dangerous game. And when you keep running out of money, the investors take over. They're the ones in control. If you don't need their money, you're in control. The founder's in control, right? So that's how we think about it.
I mean, it's challenging though, because I think that, I don't know if you've read the book Exponential, The Exponential Age. I mean, there are more winner take all markets, and the part of the, Google did do it in a different era, but ways to get towards that is capital, and capital is becoming more and more of a moat in capital as a differentiator. So I agree with you. I mean, we have a company in kind of the remote payroll space, and they beat out competition every time they get in front of a potential customer. At some point, though, they don't have they haven't raised the capital to be able to necessarily throw money at that problem, right? And have a loss leader as a product that first goes in, and then you're sort of land and expanding. So it's tough. Like if you have an incredible technology differentiator and that has an edge over for the next 5 years, fine. But I think where more and more sectors competition, comes in very fast, and your technology edge just is really not there, and capital becomes the differentiator, and so it's tough, and that's happening, it's more and more prevalent.
Yeah, it's yeah. There's no right or wrong answer, because Coupang is a prime example of using capital as a weapon. We raised $1 billion from SoftBank, and in Korea, tiny little market of Korea, nobody else was going to raise $1 billion.
Right.
And then after that, we raised another $2 billion. So we raised $3 billion when nobody else could raise $3 billion in a market. So that's how they became so dominant in Korea. But Roblox is the other example where they built this massive business on $10 million of capital. That's it. That's all we need.
So how do you go about putting together that seed round? And I mean, a number of you write checks as seed investors and are helping companies that are putting together that seed round. You can't really radiate the "I don't need money" story when you're trying to syndicate a seed round. So how do you put that together?
I think someone has to take the conviction to say, this is the new reality. And then, like, the same as you do with values, radiate that out there and create that reality and say, there's capital for you. You will build this, it's the same kind of playing field, depending on your risk level, how much capital you want to build an industry and so what into the company. But there will be capital out there, and then finding the right partners to support that vision. But I think now the field of venture has expanded and sort of diversified so many ways that there's more like listeners in general in the audience to support that vision. And if you don't have kind of that conviction that this is the new reality, it's harder to operate, I guess. Maybe I'm being overly naive.
No, I mean, we do build our network to a greater and greater size, so that I mean, Early Bird has that story with UiPath, which is I think they took it out to 30, 40 investors, and out of that, Credo and Seed Camp said yes, right? And so everyone else said no. And so we do that. We have enough of a network in all kinds of niches, and you're keeping that warm, and so we're always kind of nurturing that network to say there's probably someone there that we like, that we rate, that's gonna say yes. Rossum, everyone has their little crops of photos of, like, you sent it out, an investor said, 0.9 said, I am crying about that right now because General Catalyst just led $100 million round, and there is like, I'm crying because you begged me to put money into this company, and I said no, right? And I said, great, thank you for sending me that, right? And so that sticks in his mind for another day. But Local Globe did say yes, right? And then we're off to the races after that, and attract someone like GC. So we that's what we do. We nurture a wider and wider and better network, and sometimes we're not, we shouldn't be doing that much work sometimes, but we do, is like, want to get this funded, and someone's going to come along this journey with us, and they have, and we've got great success stories for that.
I mean, so I love to hear my GC family, cited there. So I love those stories. But just getting hyper tactical on seed fundraising, as it pertains to anyone, in this chat. I think first and foremost, just a few very tactical pieces. A lot of it comes down to the design of the presentation material. I would say that honestly, sometimes that is the first place to overinvest. And this is advice that I gave myself. I charted out to build my own venture firm last year. And I, thought it was super important to have a deck that had much more love and polish than I was ever going to be able to do on my own in Google Slides. And I think that represented the intentionality I had around the work, but just with the set of skills and investment that I don't know my way around Photoshop nearly well enough to design a beautiful deck, but I think it starts there. You know what I mean? And just in terms of creating opportunity. I think the second, a friend of mine kind of terms this as, he describes it as, Connie from Kindred described it to me as surround sound, which is you've got to get ready to activate any folks, around someone that you're trying to get to, just to activate all the nodes around them. So, that person may have went to school with, someone in their portfolio, someone that looks like they've co-invested with them. You got to operate, create that kind of surround sound experience, because I can guarantee you, if we say, hey, chocolate ice cream is worth a try, and then tomorrow someone says, hey, chocolate ice cream, have you ever, given it a try? And then that following day, someone says, yeah, chocolate ice cream, you got to, it's definitely worth trying a scoop. They're going to try a scoop of it. You know what I mean? And there's nothing more rewarding than at the end of that scoop being like, holy God, now I know what everyone's been talking to me about, You want to be that founder, you know what I mean? Like, and you got to show up with the goods, you know what I mean? But you can engineer all of that kind of, that kind of preamble. And so I think to a lot of the points shared here, I mean, fundraising is an exercise in and of itself that is often independent and decoupled from the merits of the business itself, which is, I think, just a truth. And so you can choose to, really exercise, you know what I mean? Like that fundraising skill and use it to your advantage. And that's something that, I feel like we can definitely share some more, kind of tactics around.
I mean, Ed, you might know, we used to bring our European companies on a roadshow across, meet VCs in their office.
I loved hosting them.
Exactly.
I love that crew.
So, I mean, to this day, we send photos to Cotu and Sequoia saying, remember, Nick at Revolut, Daniel were literally in the same room at your office, and you kind of said, nah, don't know. Sequoia did come later on in UiPath, and you see Tiger and Cotu and others in Revolut, and so we send photos. It's like, remember this moment when you almost canceled on us because you had other Route 280 or 101 companies to meet. So I mean, it's things like that is like reminder of what could have been. And next time it might be someone from Indonesia, right? Or whatever. It's like open those doors. Like First Mark, same thing, is like Matt Turk is a French guy there. He's the one who hosted us, and Synthesia came through, they led that round later, right? And so but we leaned in again on some of these expats and some of the brain drain that happened from Europe, and said, you're the French person, invite us in, you're the Danish person, like make sure and get one or two of your partners in there too. It's going to cost you an hour and a half to listen, but and you just keep at persistent, keep at it. And now we don't do the trip at all anymore because they're all flying over. Bessemer set up an office with 2 people in London. I mean, we also cut things we don't need to do anymore because, to Wendy's comment from before, this has become common, whereas we need to literally like hunt people down and let us in.
And how do those folks establish themselves to you as, I'm the French person that you need to access for France deals? And I mean, it resonates with me because I've been looking at a lot of different geographies, and frankly, my fund investing opportunities, even those in New York, where I became an LP in, Union Square Ventures, for instance, a lot of those were driven by the fact that 15 years ago, I was seen by people by VCs in the Bay Area as one of the handful of people who understood the New York venture market at the time, right? Because there were so few of us doing it. How do you today, in such crowded, overshopped, overfunded markets, become a go-to person so that if you're an emerging VC, your deal flow is taken seriously? If you are a founder looking to promote other founders or yourself, you're taken seriously?
Yeah, I like my quick reaction to that is I think number one is just being known stylistically, you know what I mean, and having a certain reputation for either a particular kind of heuristic of opportunity that you really enjoy that personally resonates, or a type of kind of founding company. So, I'll use myself as an example. I'm kind of like, it's 2 people, in a PowerPoint, and it's in New York, you know what I mean? Or it's like, these are students and they're dropping out of school and they're first time founders, you know what I mean? Like, and they're making their way to New York, right? So I think part of it has to do with, letting the other, kind of your other co-investor friends know, hey, I'm kind of that profile of founding team I really enjoy working with. And also by doing it enough times, you know what I mean? Like that also kind of, gives you the learnings to then be particularly impactful for those founders. Cause I think that's a big piece of it, it's just letting the world know. And then also those founders referencing, with each other and saying, hey, I, chit-chatted with this person, before any of the data showed up and they were like my first yes, I think they can be that for you. And so I think that's a big part of it. And I think for multi-stage firms with global presence, I think a lot of it has to do with, the reputations and the expertise that sits at the atomic level, which is the individual partners themselves, personal passion areas. I spent a lot of time in Mexico City, for example. I just love spending time there. I think that's an ecosystem, that is going to yield just many, many, many more incredible entrepreneurs over the next kind of few years. And I think more folks have kind of woken up to that too. And so I think it's also just like remembering that there's a personal aspect to all this too, right? Like, I mean, it's just like, like some folks like the weather in London, They like the weather in LA, so they spend more time in one place or the other. And so, I like sneakers, so if you have an entrepreneur who you see wearing, flashy, interesting sneakers, Like that's, oftentimes that's enough of a connection point, to want to have the chit chat and be helpful.
So I call that pushing on open door or pushing on a door that's slightly ajar. Like I think for entrepreneurs in the audience, my huge philosophy on this is like, whatever allies you like, push on those allies, do not waste your time convincing people who are against whatever you're doing or the way. It's just a waste of time. Like, I have LPs still calling me kind of saying, hey, shall I name? No, but okay. I'm calling from wherever. I'm learning about the European VC market. Will you talk about your fund? And I'm like, no, I would have 5 years ago, maybe because I saw that as my open door at the time, right? Whereas today that's not. I have other open, like they evolve over time to what who your allies are and your open doors. I keep pushing on those. Don't waste time like trying to convince. So Horsley Bridge is actually an LP, which I love, like wasting my time just because they've said no so many times. I'm like, I'll just do that call because it gives me makes me angry and it's great. Like it helps me every fundraise. I just go and like pitch to them. So only one person, but otherwise I'm just, nope, I'm not going to try to change your religion. I'm going to go with my allies and push them to help me.
Yeah, I call it finding your people. You just have to find your people. You talk about like, UiPath pitching 40 investors and only 2 said yes. You only need 1 or 2 to say yes. You don't need to convince all these naysayers and all these other people. You believe me, you could try to change your mind. You're not going to change your mind. Just accept that reality and find your people and do your thing. And who cares about the rest of the world,
So I'm not saying that Peter is right or wrong on like invest in your deck, but given what I know about you, Ho, when Peter said invest in your deck and in that, in making that presentation great, does that break your heart just a little bit? Because he is right.
Well, yeah, it does. But look, you mentioned the Foxes and Hedgehog blog post. I wrote it 16 years ago. If anybody's interested, it's on our website. Just please read that website because I talked about this. I've been talking about this for a long time, right? Really, really long time. Nobody listens to me. But but that's what I do. I say, forget about fundraising. Focus on the company. I love people who are terrible pitchers. I'm a terrible pitcher. Like the reason that our public stocks are not valued at below the private company stock values is because we're terrible fundraisers. So we raise money at very low prices. So by the time it goes public, the stock price is actually higher than the private values. But I know a lot of other people who are so great at fundraising. They're raising money at these great prices and they take it public and it's a down round. After you go public, it goes down. You're like, I'm terrible at that. So I'm not a good fundraiser. I've never been, and I don't like investing in other people who are great fundraisers because if they are pitching me, it kind of gives me the heebie-jeebies and I feel like I'm being played and I don't want to be part of it. Like, how Buffett just never participates in auctions. You know, like we're talking to KKR and TPG and all this, like, we want to invite you, you know, Warren Buffett to come in to look at this deal. He's like, what the heck? Like, haven't you been reading anything I've been saying for the last 50 years? It's like, it's a quick no, like it's an immediate no. So like, I've been saying this stuff for a really long time, guys. Nobody ever listens to me. So I'm not going to try to convince anybody that fundraising prowess is not important to focus on. All of these other things are important to focus on. Creating value is what they focus on.
Yeah, and we should get a tiny violin for Ho, because with his 50,000 Twitter
Nobody
followers and
listens
his
to him.
personal billions, he feels unheard. And
Oh,
I'm no, but I am with you. I mean, there's a founder who pitched at an event we hosted, and I want to say 04. And I said at 10 minutes, this was like, we did pitch fests because there were like 12 angels in our area, and we, you know, and I said, we're gonna bring on the hook at exactly 10 minutes. And he said, it won't be a problem. I have an internal clock. I've pitched so many times that I will stop like a second before the buzzer. And then he did, and it was an amazing pitch. And I was like, I'm out, because I remember the sophists. That does not end well. And it's like when I bought my first car, I was like a third-year lawyer, and I walk onto the lot and the guy says, hey, you're a college graduate, right? And I'm like, shit, I'm about to get fleeced and there's no way I can protect myself. You know, like you just know it, right? So there are people who feel that way, and then there are people who you know, but damn it, Peter, you're right about the deck. It's like, you know, the pitch, the deck, it's tough.
Totally. I think it's just an art, but like, Ho's awesome. I just love that this last few
100%.
minutes. And I think you have
100%.
fan club now and the whole sort of Zoom chat. So, but I think it's an art around how do you pitch. So I agree with Peter. Like your deck needs to look absolutely amazing and stunning, and investing in the appropriate level of design so that you're not giving the person who is really judging you some reason to be like, oh, like this person has some like doesn't have attention to detail or didn't put the time and effort and respect into actually having their narrative fully kind of baked in a way where we can have a conversation around it. That being said, when founders do pitch, and you can tell it's like it's like perfected and rehearsed to the point where it's like, oh my God, like what the hell are you dishing here right now? It just loses that authenticity around the pitch. Like what our investors are trying to do is like get to know founders as human beings and people. And anytime I'm hearing a pitch where it's overly rehearsed, it's practiced, perfected, I realize like, I have no idea who I'm talking to on the other end of the Zoom call or in person. And that gives me the heebie-jeebies. And I'm just like, wait a minute, if I give this person $1, like they're gonna like probably torch this thing in the ground. I want to get to know someone as a person. And then from there, we'll have the permission to judge whether the company is something that we should go on this journey together with. And so I think both Peter and Ho have like, I think a balance of both perspectives. I think make a ton of sense about how founders can think about this.
You know, you asked a question before about kind of, you know, how do you try to go beyond your own biases and we form our own true, you know, through our career too. I mean, I still think curiosity and seeing curiosity in the founder, to me, that's still colorblind, gender blind. Like you inherently display a curiosity about the problem you're fighting against, you know, the solution you're providing. You don't. I mean, that's where we try to double, triple down, is like ask a ton of questions, you know, and dig for that, and matching that curiosity, seeing that it's going to last a decade or more. And again, matching that with how much work have you done? Have you, you know, to Peter's point before, if that particular curiosity is within something and, you know, have you stalked us on Twitter or where LinkedIn, like, you know, how deep does that curiosity run? How deep does that hard work run? And so I still think that's probably the biggest weapon against as much, you know, any bias we're developing. And
so
yeah.
And I go ahead, Wendy.
I was just nodding in agreement, but I'll add that curiosity is definitely one of the values that, you know, we really look for as well. And the thing with values, when you can tell this in a pitch meeting, you know, curiosity being one, kind of high performance standard being potentially another one, and also, you know, like the need to grow. All of these things, they come.
Oh, the WeWork, it's not working.
So, and WeWork is a stock that if you applied Ho's philosophy, you would not have made money. It was, I kept saying for years, like if I could short one venture-backed stock, it would be WeWork. And I just like, I was wrong for years. Wendy,
Love
sorry,
it.
finish your thought.
I'm not sure how much I got, but those values, they compound over time. So, you know, significantly, because, you know, you're pouring your soul, your existence into compounding those values. And that's, you know, what gives us conviction. And I think sometimes they can come across in pitches that are hyper rehearsed, but usually not.
And I want to just, because I'm looking at stuff in the chat, and I see that Naza and Kobe have said some things, and Damla, it's not being overly prepared. I think it's the authenticity. It's also being able to be non-linear, to lean into a question, to not be rigid about, I have to get through my deck in order. Please do not interrupt me. I am here to tell you my story. I also want to make it clear, it's not a disqualifying factor if you've given the pitch 100 times. It's not even a disqualifying factor if I've heard the pitch 100 times. It's just, I think people want to understand who you are as a person, and I think they want to connect as a person. And if you are not radiating that there is something about who you are as a person that makes you do what you do, that's the problem. That's where it's a sales pitch for a product that you're hawking, rather than for a company that you feel compelled to found and run and raise capital for. And that's what I would encourage people to lean into. And because of that, because the thing that's so important here is the almost extension of self that your company or your fund become, I want to say something about something that happened on Twitter about a week or two ago. And I'm not going to dignify the individual by mentioning his name. And I don't often go back to quoting Dr. King, but seeing as how his birthday is 3 days away, his actual birthday is 3 days away, I was particularly troubled by the silence that accompanied that comment, because as Dr. King said, in the end, we will not remember the words of our enemies, but the silence of our friends. And it's not the cruelty by the bad people, it's the silence by the good people in response. So I think that it's really important, because I know that particularly underrepresented people felt demoralized by seeing the absence of reaction to a comment that was racist online by someone who started and runs a very successful venture fund. And there are a number of us, and Wendy, I want to applaud your partner and mine in First Close, PJ Parson, because one of the few white VCs who actually called it out, and yes, it was sexist, Sheila, who actually called it out was PJ in Stockholm. And he doesn't care. I know I called it out. I know a number of people, Charlie O'Donnell was another, and Jeff Busgang wrote a LinkedIn post about it. But it's really important. And there is this thing that goes on, and there's a great article from the Seattle Times in 2019 where NBC News sent reporters a note saying, as to a particular congressperson who said something racist. He said, and NBC's note was to its journalists, be careful to avoid characterizing his remarks as racist. Instead, you should say remarks that many are calling racist. And I just kind of want to call bullshit on that. We need to call this stuff out, and we need to acknowledge that if we're asking people to put their whole selves into their business, to be their genuine selves. We cannot demoralize them by remaining silent when people say horrible, dehumanizing things. So I'm just gonna throw that out there. Sorry to take.
Agree. I mean, agree. And I'm sure also there are folks who may not, whether we agree with this part or not, feel comfortable that they can articulate themselves against that, right? But we can also take actions versus words only beyond that, which is, even historically I've done where someone was convicted of a sexual abuse in UK, and I was asked to be on a panel with that person, and I said, no, I won't. Either you take that person or me, but I won't be on that panel. And here's the link to that conviction, because you didn't know. And the person said, I didn't know. And I said, well, there you go. My job is to make sure that person's been convicted of a crime. And, so obviously they chose me to be on the panel. But so I do think, even if maybe didn't tweet it out that, hey, so-and-so is convicted, the actions. So I do encourage, if some people don't feel as comfortable going on Twitter, is we can take action. So for sure, I won't be investing with that person, ever, right? And so there's actions and there are words too. We do need words out there, but we also can take actions.
So I would say, look, I'm glad we're talking about this. And look, even before any comments that he made, that's already affirmed that I wasn't going to do anything with. So it was kind of not on our list of firms that we would ever do deals with anyway. But at the same time, I just think we live in a dangerous world with social media and people jumping on bandwagons and persecuting somebody just because of one comment on Twitter. So I take the other side as well. We just have to be careful, not have a crazy mob mentality and persecuting people in public. I just think there are two sides of it. So, there are dangerous things happening on both sides.
I think we might spend too much time platforming and worrying about the other side. And
it was an outrageous comment. I agree with you. It was ridiculous. It was just like uneducated, ridiculous.
But there's also a difference between denouncing the human and denouncing the comment. And I focused on denouncing the comment rather than the human. Humans make mistakes. That doesn't mean that I think that person should be given equal time. And, I also think that because the systemic racism, the systemic bias was implemented and is perpetuated by people who look like me, who present socially the way I do, it is incumbent upon me to use my privilege in this particular way. And I think too often we leave it to the people who are directly targeted by such comments to denounce the comments. And I want to draw a distinction, Ho, because there are definitely opportunities where I think, give someone grace because they made a mistake or something is a teachable moment. I don't know that this one was a mistake or teachable moment. And I also think that with authority, with authority and success, you also have an obligation, as that person does, to not spew racist stuff. And it came a few months after he had spewed some other stuff. So
and honestly too, if you're going to take the social media to say something as such as bold, you got to be open to the ridiculous backlash of social media. So it's like he opened up in that venue, so it's just I feel no sort of pity for oh well, the mob needs to hold back. It's like you are in the mob talking about it. So
yeah.
I mean, and
it's a good discussion. Yeah, for sure.
In a world where, especially us coming in a pre-seed and seed, where we have an influence on where our companies take money from, and that person is not on the list. So, and I'm fine saying that, not just that comment's not on the list, that person's not on the list. And I will.
Go ahead.
I promote my views on people. I have the power to. And again, I want a world where this, this forum is that's what exists in the world and not that. So I'm unapologetic about it.
And you do get to, you do have options when choosing with whom you want to do stuff, and people are going to seek him out for it, and people are going to avoid him for it. Not a terribly close call for me. So I really appreciate all of you being here and people staying on this long. I know we've now run over, which is surprising, but thank you for indulging. And it's a great excuse to see lots of faces. It's also a great excuse for me to get to spend time with people I admire and respect. And if you haven't read Wendy's blog post, which we didn't get to talk about creating value out of thin air, I would encourage you to do that as well. And I have seen people in the chats saying that they just signed into or up for Valence, which is awesome. But I really want to thank Kobe and Peter and Reshma and Ho and Wendy for everything that you're doing, for taking time for us, for sharing candid insights, and for the things you're putting out into the world. Hope to see a bunch of you on January 24th for Mac and Westmore, and I think Mac now gets to go by like just the first name. And Laura, I think it's going to be a great event. I want to thank our event team here at Lowenstein that makes these Venture Crush events happen. Karen, Carrie, Brittany, Katie, Betty, my amazing admin, Angela, as well. And my colleagues, Claire Dronzik, IK Omaruna, Kay Komoro, Kelsey Repka, and Ko Tran, who did the research for today. And all of you for being here, and also my partners at First Close Partners, who are dedicated to investing in underrepresented funds, underrepresented led venture funds anywhere in the world. And we have now completed more than 75 investments as LPs into those funds, including Stellation, and including with the backing of folks that do include Wendy, Ho, and Reshma. So thank you all, and have a terrific day and week.
Thank you.
Thanks for
Thank
getting
you.
us together. Ed.
Pleasure.
Great
Thanks
to
for
see
having
everyone.
us. Yeah, great to see you guys.
Guys, bye.
Rock
Take
on.
care.